Look, I need to be straight with you about something that's happening right now in the precious metals market. And I'm not talking about some theoretical scenario that might play out over the next few years. I'm talking about a situation that's unfolding this week, and if you don't understand what's happening, you could miss one of the most important buying opportunities we've seen in recent memory. Here's what I want you to understand. The gold and silver markets are not like other markets. They don't move on fundamentals alone. They move on positioning, on sentiment, on technical levels that have been established over decades of trading. And right now, we're sitting at a confluence of factors that rarely align all at once. Let me paint you a picture of what's actually happening behind the scenes. Central banks around the world have been accumulating gold at a pace we haven't seen since the early 1970s. We're talking about over 1,000 tons purchased for 3 consecutive years. Think about that for a moment. These are the institutions that print money, that control interest rates, that have access to every piece of economic data before it hits the public. And they're converting their paper assets into physical gold at a record pace. But here's where it gets interesting. While central banks are buying, the commercial traders on the COMEX, the big banks and institutions that typically suppress price through paper contracts, they've reduced their short positions to levels we haven't seen in years. This is critical. When the commercial shorts step aside, when they're not actively fighting the price higher, that's when we see explosive moves. That's when gold can run from 2,600 to 3,000 in a matter of weeks, not months. Now, silver is a completely different animal, but it's showing the same setup. The gold to silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, has been hovering in a range that historically precedes major silver rallies. When this ratio compresses, when silver starts catching up to gold's gains, we see moves that dwarf what happens in the gold market. We're talking about 30, 40, 50% gains in a matter of months. But let me tell you what's really driving this urgency. It's not just about the charts or the technical setups. It's about the physical market. There's a disconnect happening right now between the paper price and the physical price. Dealers are reporting premiums on physical metal that are 2, 3, sometimes 4 times higher than normal. That means people are willing to pay significantly more than the spot price to get their hands on actual metal. Why does this matter? Because the paper market, the futures contracts traded on the COMEX, that's where price discovery happens. That's where the world looks to see what gold and silver are worth. But if you can't actually buy physical metal at that price, if you have to pay a massive premium, then the paper price is a fiction. It's a number on a screen that doesn't reflect reality. And here's what happens when that disconnect gets too wide. The paper market breaks. We saw this in March of 2020 when COVID hit. The COMEX gold futures were trading at $1,700, but you couldn't buy a gold coin for less than $2,000. The market seized up. Dealers ran out of inventory. The U.S. Mint suspended sales, and when the dust settled, gold had rallied to over $2,000 and stayed there. We're seeing early signs of that same dynamic right now. Not as extreme, not yet, but the warning signs are flashing. Mints around the world are reporting strong demand. The U.S. Mint's sales figures for gold and silver eagles are running well above average. The Perth Mint in Australia, the Royal Canadian Mint, they're all seeing the same thing. Retail investors are buying physical metal at a pace that suggests they understand something big is coming. Now, let me connect this to something that affects you directly. If you're sitting on retirement accounts, if you have money in a 401k or an IRA, you need to understand that those accounts are denominated in dollars. And the dollar, despite what you might hear about its strength, is in a precarious position. The national debt just crossed $35 trillion. The interest payments on that debt are now over $1 trillion per year. That's more than we spend on defense, more than we spend on Medicare. Quick aside here, and this is important. If you have $100,000 or more in retirement accounts, I've put together a comprehensive guide on how gold IRAs actually work. It's in the description below. It covers the mechanics of getting physical gold into your retirement account without triggering tax penalties, how the storage works, what the fees look like, all of it. If you're in that situation, it's worth taking 10 minutes to understand your options. I'll put the link right there. But back to what's happening this week. The Federal Reserve is in an impossible position. They've been trying to fight inflation by raising interest rates, but they can't raise them too high because the government can't afford the interest payments on the debt. So they're stuck. They can't fight inflation aggressively without bankrupting the government, and they can't lower rates without reigniting inflation. It's a trap, and gold is the beneficiary of that trap. Here's what most people don't understand about gold. It's not an investment. It's not something you buy hoping it goes up so you can sell it for a profit. Gold is insurance. It's a hedge against the debasement of currency, against the inevitable outcome of governments printing money to pay their bills. And right now, every major government in the world is doing exactly that. Look at what's happening in Europe. The European Central Bank is dealing with negative growth, high energy costs, and political instability. Japan has been printing money for 3 decades and their debt to GDP ratio is over 250%. China is facing a real estate crisis that makes the US housing bubble look small by comparison. These are not stable situations. These are powder kegs waiting for a spark. And when that spark comes, when the next crisis hits, where does money flow? It flows to safety. It flows to assets that can't be printed, that can't be devalued by a central bank decision, that have held value for 5,000 years. It flows to gold and silver. Now, I want to talk about timing, because this is where most people get it wrong. They wait for confirmation, they wait for gold to break to new all-time highs, for silver to cross $30, for the mainstream media to start talking about it, and by the time that happens, the easy money has been made. The move from 2,600 to 2,800 in gold, that's a 7.5% gain. The move from 2,800 to 3,000, that's another 7%. But the move from 3,000 to 3,500, that's where the real gains happen. And that's when everyone is buying. The smart money, the people who consistently profit in these markets, they buy when it feels uncomfortable. They buy when the price has pulled back, when sentiment is negative, when everyone else is focused on other things. And that's exactly where we are right now. Gold has consolidated for weeks. Silver has been range-bound. The talking heads on financial television are discussing stocks and crypto and everything except precious metals. This is the opportunity. Let me give you a specific example of how this plays out. In 2008, during the financial crisis, gold dropped from over $1,000 to $750 in a matter of months. Everyone thought the bull market was over. The bears were out in force, saying gold had topped, that it was going back to 500. But the smart money was buying. They understood that the crisis would force central banks to print unprecedented amounts of money. And they were right. By 2011, gold had rallied to $1,900. The people who bought at $750 made 150% returns in less than 3 years. We're in a similar setup right now, but with one critical difference. The fundamentals are stronger. The debt levels are higher. The geopolitical tensions are more severe. The supply and demand dynamics in the physical market are tighter. Everything that drove gold higher in the past is present today, but amplified. And silver. Silver is the real story here. Silver is used in everything from solar panels to electric vehicles to electronics. The industrial demand for silver is growing while mine supply is declining. We're pulling silver out of the ground at a rate that can't keep up with demand, and the above-ground stockpiles that have buffered the market for decades are being depleted. When the investment demand kicks in, when people start buying silver not just for industrial use but as a monetary metal, the price could move in ways that shock people. Think about this. In 1980, silver went from $5 to $50 in a matter of months. That's a 10 times return. Now, I'm not saying we're going to see that exact scenario play out again, but the setup is there. The gold to silver ratio is telling us that silver is historically cheap relative to gold. The physical market is tight, the industrial demand is strong, and the investment demand hasn't even started yet. Here's what I want you to understand about protection. When I say don't let this week pass without buying, I'm not talking about speculation. I'm not talking about trying to time the perfect bottom or squeeze out an extra percentage point of gains. I'm talking about protecting what you've already built. If you've spent decades saving money, building a retirement account, accumulating wealth, you need to ask yourself a serious question. What happens to that wealth if the dollar loses 20, 30, 40% of its purchasing power over the next few years? Because that's not a hypothetical scenario. That's what happens when governments print money to pay their bills. That's what happens when debt levels become unsustainable. That's what happens when the bond market loses confidence in a currency. And we're seeing the early signs of that loss of confidence right now. Look at what's happening in the Treasury market. Yields are rising even as the Fed tries to control them. Foreign central banks are reducing their holdings of U.S. Treasuries. The BRICS nations are actively working to create alternative payment systems that bypass the dollar. These are not small developments. These are tectonic shifts in the global monetary system, and they all point in the same direction. Now, I know what some of you are thinking. You're thinking that gold and silver have had their run, that they're expensive at these levels, that you should wait for a pullback. But here's the thing about waiting. Every day you wait, you're making a bet that the current system holds together, that inflation stays under control, that the dollar maintains its value, that the geopolitical situation doesn't deteriorate. And maybe you're right. Maybe everything works out fine. But what if you're wrong? The cost of being wrong about this is catastrophic. If you wait and the price runs away from you, if we see gold at 3,000 and silver at 35 and you're still sitting in cash waiting for a pullback that never comes, you've missed the opportunity to protect yourself. And unlike stocks, where you can always find another company to invest in, there's no substitute for gold and silver. There's no alternative that provides the same level of protection against currency debasement. Let me tell you about the mechanics of what's happening in the COMEX market right now, because this is important. The COMEX is where the big institutions trade gold and silver futures. It's a paper market, meaning most of the contracts never result in physical delivery. Traders buy and sell contracts, settle in cash, and move on. But there's a limit to how much physical metal backs those paper contracts, and when too many people demand delivery, when the physical market gets tight, the whole system comes under stress. We saw this dynamic play out in March of 2020. The spread between the futures price and the physical price blew out to unprecedented levels. The COMEX had to change its delivery rules to allow for different types of gold bars, because they couldn't source enough of the standard 400-ounce bars. The system was on the verge of breaking, and it was only saved by emergency measures from the Fed. Right now, we're not at that crisis point, but we're seeing the same warning signs. Open interest in gold futures is high, while registered inventory, the metal that's actually available for delivery, is relatively low. The ratio between paper claims and physical metal is stretched. And if we get a catalyst, if something happens that causes a rush into physical metal, the system could break again. And when it breaks, the price doesn't just go up gradually. It gaps. It jumps. You wake up one morning and gold is up $100 and you can't get filled at any reasonable price. This is why timing matters. This is why waiting for the perfect entry point is a mistake. Because in markets like this, the perfect entry point is when you can still get metal at a reasonable price, when the premiums are manageable, when dealers have inventory. Once the rush starts, once everyone realizes what's happening, it's too late. Now, let me address something that I hear all the time. People say, but gold doesn't pay a dividend. It doesn't generate cash flow. Why would I own something that just sits there? And that's a fair question if you're thinking about gold as an investment. But again, gold is not an investment. It's insurance. You don't buy fire insurance on your house expecting it to pay you dividends. You buy it because if your house burns down, you're protected. Gold is the same thing. It's protection against the house burning down, except in this case, the house is the monetary system. And here's the thing about that insurance. It's cheap right now. The premiums on physical gold and silver, while elevated from historical norms, are still reasonable compared to what they could be. You can still buy metal and take delivery within a reasonable time frame. You can still find dealers with inventory. But that window is closing. Every week that passes, every month that goes by with central banks buying and retail demand increasing, that window gets smaller. Think about the people who bought gold in 2001 when it was $270 an ounce. Everyone thought they were crazy. The stock market was where the action was. Tech stocks were recovering from the dot-com crash. Gold was a relic, a barbarous relic, as Keynes called it. But those people who bought at $270, they watched gold go to $1,900 by 2011. They made 7 times their money while protecting themselves from the debasement of the dollar. We're at a similar inflection point right now. The difference is that the fundamentals are even more compelling. The debt levels are higher. The geopolitical tensions are more severe. The supply and demand dynamics are tighter. Everything that drove gold higher in the past is present today, but amplified. And yet, most people are ignoring it. They're focused on artificial intelligence stocks and cryptocurrency and whatever the latest trend is. They're missing the forest for the trees. Here's what I want you to do. I want you to take a serious look at your financial situation. Look at how much of your wealth is denominated in dollars or dollar-based assets. Look at how much exposure you have to the banking system, to government bonds, to assets that depend on the stability of the current monetary system. And then ask yourself, what percentage of my wealth should I have in assets that are outside that system? Assets that can't be printed, that can't be devalued by a central bank decision, that have held value for thousands of years? For most people, That number should be somewhere between 10 and 20% of their liquid net worth. Not so much that you're betting the farm on a collapse, but enough that if things go sideways, you're protected. Enough that you can sleep at night knowing that no matter what happens to the dollar, to the stock market, to the banking system, you have a foundation of real wealth that can't be taken away. And here's the critical part. You need to own physical metal, not ETFs, not mining stocks, not futures contracts. Physical metal that you can hold in your hand or that's stored in your name in a secure vault. Because when the crisis comes, when the system comes under stress, paper promises don't mean anything. The only thing that matters is what you actually own, what you can actually access. I've seen this play out too many times. I've seen people who thought they were protected because they owned shares in a gold ETF, only to find out during a crisis that the ETF doesn't actually have all the gold it claims to have. I've seen people who owned mining stocks watch those stocks get crushed even as the price of gold was rising. Because mining stocks are still stocks. They're still part of the financial system. They're still subject to all the risks that come with that. Physical metal is different. It's outside the system. It's no one else's liability. It's not dependent on a company's management or a government's promises or a bank's solvency. It's just metal. And in a world where everything else is built on debt and promises and paper, that simplicity is incredibly valuable. Now let me talk about silver specifically, because silver deserves its own discussion. Silver is often called the poor man's gold, but that's a misnomer. Silver is not just a cheaper version of gold. It's a completely different asset with completely different dynamics. Gold is primarily a monetary metal. Yes, it has some industrial uses, but the vast majority of gold demand comes from investment and jewelry. Silver is different. Silver is both a monetary metal and an industrial metal, and that dual nature creates unique opportunities. The industrial demand for silver is exploding. Every solar panel uses silver. Every electric vehicle uses significantly more silver than a traditional car. Every smartphone, every computer, every piece of modern electronics uses silver. And as the world transitions to renewable energy, as electric vehicle adoption increases, as technology continues to advance, the industrial demand for silver is going to continue growing. But here's the problem. Silver mine supply is not growing. In fact, it's declining. Most silver is produced as a byproduct of other mining operations, primarily copper and zinc. And when those base metal prices are low, when mining companies are cutting back on production, silver supply suffers. We're in a situation where demand is growing while supply is constrained, and that's a recipe for higher prices. But the real kicker is the investment demand. Right now, investment demand for silver is relatively muted. People are buying some coins and bars, but it's nothing compared to what we saw in 2011 or in 2020. When investment demand kicks in, when people start viewing silver not just as an industrial metal but as a monetary metal, as a store of value, the price can move in ways that shock people. Remember, the silver market is tiny compared to the gold market. The entire annual silver production is worth maybe $30 billion. That's less than the market cap of many individual companies. If even a small percentage of global wealth decides to move into silver, the price impact would be enormous. We're talking about a market that could easily double or triple in price if investment demand returns to previous levels. And here's what makes this week so critical. We're at a technical level in silver that has acted as support multiple times over the past few years. Every time silver has come down to this level, it's bounced. Every time the bears have tried to push it lower, the buyers have stepped in. This is not a coincidence. This is a level where physical buyers, the people who actually use silver, who actually need it, they step in and buy. And when you have that kind of physical support under a market, it creates a floor. It creates a level where the downside is limited, but the upside is wide open. Think about the risk-reward here. If you buy silver at current levels, what's your downside? Maybe it goes 10-15% lower before bouncing. That's your risk. But what's your upside? If we see a return to the highs from a few years ago, you're looking at a 40-50% gain. If we see a real bull market, if investment demand returns, and the industrial shortage becomes acute, you could be looking at a double or triple. The risk-reward is asymmetric. The potential gains far outweigh the potential losses. This is what professional traders call a high-conviction setup. It's a situation where the fundamentals, the technicals, and the sentiment all align to create an opportunity with limited downside and significant upside. These setups don't come around often, and when they do, you need to act on them. because the market doesn't wait for you to be ready. The market moves when it moves, and if you're not positioned, you miss it. Let me bring this back to the bigger picture, because this is not just about making money on a trade. This is about understanding the world we're living in and positioning yourself accordingly. We're in the late stages of a debt-based monetary system that has been in place since 1971. For over 50 years, the world has operated on a system of fiat currencies backed by nothing but government promises. And for 50 years, that system has worked, more or less. But systems like this don't last forever. They can't last forever. Eventually, the debt becomes too large, the promises become too expensive, and the whole thing comes apart. We're seeing the cracks in the system right now. We're seeing inflation that central banks can't control. We're seeing debt levels that can't be sustained. We're seeing geopolitical tensions that threaten the dollar's role as the world's reserve currency. These are not small issues. These are existential threats to the current monetary system. And when that system comes under stress, when people lose confidence in paper currencies, they turn to real assets. They turn to gold and silver. This is not doom and gloom. This is not predicting the end of the world. This is simply recognizing that the current system has a shelf life, and that shelf life is getting shorter. And if you understand that, if you accept that premise, then the logical conclusion is that you need to own some gold and silver, not as a speculation, not as a trade, but as a core holding, as a foundation of real wealth that will be there no matter what happens to the paper system. So when I say don't let this week pass without buying, I'm not trying to create false urgency. I'm not trying to scare you into making a rash decision. I'm simply pointing out that we're at a confluence of factors that rarely align. The technical setup is favorable. The fundamentals are strong. The physical market is tight. The geopolitical situation is deteriorating. And the price is still at a level where you can get in without paying a massive premium. This is the opportunity. This is the moment where you make the decision to protect yourself, to position yourself for what's coming, to take control of your financial future. Because the alternative is to do nothing, to hope that everything works out, to trust that the people in charge have it all figured out. And maybe they do. Maybe I'm wrong about all of this. But what if I'm not? What if the system does come under stress? What if the dollar does lose significant purchasing power? What if gold and silver do go on a major run? Can you afford to be wrong about this? The beauty of owning physical gold and silver is that even if I'm wrong, even if the system holds together and everything is fine, you haven't lost anything. You still own real assets with intrinsic value. You still have a store of wealth that has held value for thousands of years. The downside is limited. But if I'm right, if things do go sideways, you're protected. You have a foundation of wealth that can't be printed away, that can't be devalued by central bank decisions, that will hold its value no matter what happens to the paper system. That's what protection means. That's what this is all about. It's not about getting rich quick or timing the perfect trade. It's about making sure that the wealth you've spent your life building is protected against the risks that are out there right now. And those risks are real. They're not theoretical. They're not something that might happen in some distant future. They're happening right now, this week, this month. And the time to act is before everyone else figures it out, before the rush starts, before the premiums blow out and the dealers run out of inventory. So take a look at your situation. Think about what percentage of your wealth should be in real assets, and then take action. Don't wait for the perfect moment, because the perfect moment is when you can still get metal at a reasonable price. Don't wait for confirmation, because by the time everyone agrees that gold and silver are going higher, the easy money has been made. Act now, while you still can, while the opportunity is still here, because this week matters. This moment matters. And the decision you make right now could be the difference between being protected and being exposed when the next crisis hits.